Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario. My goal is to become the Google map for hardworking Canadians seeking financial freedom. Recently, private lending has become extremely popular among real estate investors seeking higher cash flow and passive investment strategy. Investors are making anywhere from 8% to 15% in return, which is amazing in comparison to traditional investments in the stock market. But not all private lending deals are sunshine and roses. My friend nearly lost her entire $60,000 invested in second mortgage. She turned it around and made $150,000 in return in 2 years. Today, we're going to go in depth into how she turned this deal into a $150,000 profit. Before I get started, make sure you subscribe to my YouTube channel and hit the notification button to stay on top of the latest tax tip. If you like this video, make sure you give us a thumbs up, leave us a comment below if you have any questions. Okay, now let's get started. A friend of mine entered into a private lending deal in 2019. For those of you who don't know much about private lending, basically you get to play to be the bank and lend money to others and charge interest in return. There are a few advantages of doing private lending. The first one, you qualify to invest using your RSP and TFSA funds. This allows you to earn anywhere from 8% to as much as 15% or even higher interest rate in return on these loans. Second advantage is that you don't have to deal with the tenants and toilets. Borrowers often pay for the legal fees that you incur as well. So literally, you have no cost of investment. Number 3, the term of the loans are often short. You get your money as well as the interest income back in a relatively short period of time. You get to enjoy your cash flow relatively quickly in comparison to buying properties. If you are investing in Ontario, you are not seeing a lot of cash flow these days. If you invest in a private lending deal instead, you would be able to complement your real estate investment with some cash flow. Number 4, interest income, that is return on your investment, can be substantial as compared to traditional form of investment such as mutual funds and stock investment in the market. The dividend yield that you often see in the market currently on a big bank stock is roughly 5%, 3%, and you will not see a 10%, 15% return on investment in these type of traditional investment. Number 5, some private lending loans are secure against the property. This means that if the borrower defaults and not able to repay you, the investors can potentially force a power of sale on the underlying asset, the underlying property, and recover the loan. But is there a catch? Like every other investment out there, the investors need to do their own homework, own due diligence on every single deal. Here are some potential risks that you should consider. The first one, the saying that goes, the higher the return, the higher the risk involved. If an investor is getting 15% interest in return with no underlying security, chances are the deal has way higher risk profile than a regular investment that has 8% return secure against a property. The second risk involved is the borrower's ability to repay the loan with interest. The reality is that if the borrower is not making sufficient amount of money, they have no clear business plan with how they are going to generate enough cash flow to repay you, chances are the risk profile of this deal is higher than that of someone who has solid cash flow and solid job, and they would be able to repay you with the term specified in the deal. The third risk that you should consider is the borrower's exit plan. Sometimes people borrow money from private lender just to finance a flip project. Sometimes they borrow money just to finance the renovation of their own home. And if they don't have a clear exit plan on how they are going to be able to repay you, you may not want to lend to these people. Another factor you should consider is the fair market value of the property that's used as a security. More often than not, private lending deals are being secured against an underlying property. If the fair market value of the property is low in comparison to the underlying mortgage secured, you may lose the entire principal land on this particular deal. Another factor to consider is all the other loans added up that are registered against the same underlying secured property. What it means is that the borrower might already have a regular mortgage with an A-lender bank that's registered against this property. These borrowers often have a difficult time increasing their mortgage amount with the same A-lender, and hence why they are tapping into the private money market so that they can access the equity accumulated in their house. If you are lending as a second mortgage, you need to understand the terms and conditions of the first mortgage as well. In case of default, your loan is repaid after the first mortgage is fully paid. You also need to consider the overall loan amount to value of the property. Private lenders should look at the combined outstanding loan registered against the property in relation to the fair market value of the property. If the first mortgage is $150,000 and the second mortgage is $60,000, the combined total loan amount would have been $210,000, and the full $210,000 loan is registered against the property. But if the property value, the fair market value of the property is only $200,000, your $60,000, even though it is secure against the property, may not be so secure after all, because the combined loan value would be less than the fair market value of the property. Another factor you should consider is the location of the property. If the underlying property is located in a town that has declining population, chances are it is harder to sell in case of default than the property that is located in Toronto. Location of the property also matters. Now back to my friend's deal. In 2019, she lent $60,000 private money secure as a second mortgage on a single-family home in St. Catharines. Interest rate was 14%. 14% is pretty decent. The appraised value of the property at the time was $250,000. Now, the first mortgage was roughly $152,500, and her loan is registered as the second mortgage behind the first mortgagee. For those of you who don't understand what this means, in the event of a foreclosure or power of sale, the property is forced to sell in the open market to repay the debt outstanding. The first mortgagee would be repaid first before her second mortgage is paid. Together with her $60,000 loan, the total loan to value registered on the property was approximately 85%. My friend thought that 85% loan to value provided enough buffer to protect her second mortgage amount. After all, the cost to sell a property would normally be 5% realtor commission and some lawyer closing cost. The borrower worked as an office clerk. He defaulted 6 months into the term on the second mortgage. He defaulted even earlier on the first mortgage, a couple months more earlier before that. The first mortgagee forced power of sale, and my friend got notified as her loan was registered against the property. To save the deal, she bought the property for $255,000. In her mind, she was using her $60,000 second mortgage as the down payment for the property. She got a brand new mortgage in her name for $200,000 to fund the purchase. Total consideration paid by her was $260,000, which was more than enough to cover the purchase price of $255,000. At closing, the lawyer called her and told her that, well, the deal could not be closed because the first mortgagee was owed another $30,000 interest and fees and penalties incurred from the default payment. The deal couldn't close unless she put in this extra $30,000. Well, the first mortgagee lent $152,500 and got $230,000 back from the sale of the property. Essentially, the first mortgagee charged $77,500 in fees, interest, and penalties combined. That's crazy. She paid, she closed the property, she put in another $50,000 to freshen it up and rented it out for a couple of years. Earlier this year, in 2021, she sold the property for $500,000. She made more than double of her initial investment back in 2 years. What's the lessons learned here? Well, first, If you do decide to invest in private lending, do your own due diligence. Make sure you look at the borrower's ability to repay the loan. In her case, she never looked at borrower's ability to repay the loan. Make sure you have a plan B in case of the borrower's default. And most importantly, make sure you understand the power of first mortgagee and how much they can charge in terms of fees, interest, and penalties. You might have a plan B, but the plan B might not work out if the first mortgagee is as powerful and aggressive as the one in this deal. You might wonder, can she write off the $30,000 that she put in extra to close the deal? Absolutely. It is added to the cost of the building of the purchase, and she can deduct it against the sale price. That is how my friend turned her sour private lending deal to $150,000 profit in 2 years. If you have any questions about this private lending deal, feel free to leave a message below and I will get back to you personally, although I'm not a mortgage broker for the record. If you like this video, make sure you subscribe to our YouTube channel and give us a thumbs up. Thanks for watching.